Taking money out of your retirement accounts is not easy. Is it a tax-deferred account or is it a tax-free account? Are you taking too much? Are you taking too little? And the one annoying factor is a required minimum distribution kicks in at some point in your life. The age keeps changing. We're going to take you through the complicated things and fix it all for you. We'll see you on the other side of the intro. Welcome back to another episode of Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend, and today we're talking about required minimum distributions, the acronym of RMDs. We're going to go through some of the complicated things that happen, and we're going to try and make it a lot more simpler for you. We split our podcast into a number of different sections. We dive deep into content. We answer questions about that content to make sure you understand it clearly, and then we share a little bit about ourselves personally and professionally. Without further ado, let's dive in. If you are a fan of Reddit, you know the section called ELI 5, which means explain it like I'm 5. So when we're talking about RMDs, we are talking about required minimum distributions. The IRS has a whole guideline of when you have to take something out of your retirement account at a certain age and a certain formula. It can change depending on what type of account it is, whether you've inherited it, or it is your own account. So let's dive into kind of the nuances of that and what you should be doing.
So,
Heather, before I dive in, what do you want to say?
if you inherit a retirement account, you most likely have an RMD if you weren't married to this person. So if you're a kid, if you're a grandchild, and you inherit a retirement account, you most likely have a requirement. Number 2, if you are above the lovely age of 73, you have a requirement to take money out of your retirement account every year.
73 is interesting because I'm sure a lot of people are like, hold on, 73? Like, yeah, it used to be 70 and a half. Then it was 72. Then it was 73. The IRS is constantly changing it. So it's making it more confusing for people trying to figure out when they have to take money out.
In the last 5 or 6 years, let's say, and multiple times in the past 5 or 6 years, tax laws have changed with regarding to RMDs, required minimum distributions. It's going to change again in
2033.
Yeah, so apparently if you're born 1960 or older, your RMD age is going to be 75. But that's a 2033 problem. Right now, if you are 73 and above, that is the age we're going to use in talking with the podcast. So it's normally over your life expectancy table. I'm not going to go into the weeds of that. Your brokerage, like literally Schwab or Fidelity, has a calculator. You put in your age, your date of birth, and your prior year account balance. That's how it's determined. And then it divides by some number. For ease of this,
the balance of your account on the end of December.
Yes.
Last year.
And so you need to pull that statement and the RMD for the following year. So right now, as Dave and I are doing 2025 RMDs for our clients, we need to know their 12/31/2024 balance. So we take that number. Let's say it was $1 million for ease. Their traditional IRA was $1 million on 12/31/2024. And then we take their age, and based on that number the IRS gives, let's just say it's 27. But for ease, let's pretend it's 27. You would take 1 million divided by 27. And then whatever that number is the RMD requirement for the year. So why I'm giving that example is that could be kind of a sizable number if your IRA account grows.
It can be. And if you've also got other types of income, which are taxable, and it's pushing you into a tax bracket, and now you don't have a choice. Like, you have to take this money out or you're going to get penalized by the IRS.
I love how you say penalized. Penalized, not penalized?
Penalized. All right, we're going to go on a tangent. Is it the penal code or the penal code?
Oh, you're saying it correctly. Penalized.
I know.
It sounds
I'm
weird,
correct
though.
all the time, Heather. All the time. I'm
correct.
I
know. Okay, so to go back to this.
Don't let my wife see this.
RMDs accelerate how much you have to take out for ease, increases the older you get. Why? Because You didn't pay tax on this money when it went in. So guess who wants their payday? The IRS. These are in general numbers so people understand. So if you're 73, you have to take about 3 to 4% as an RMD. Guess what it is when you're 90? 8%. So if you have $1 million, right? You're having to take somewhere between $30,000 and $40,000 a year on your IRA, right? But if you're 90, you got to take 80. That's double. So, and I'm not going to go on a tangent here, but there are strategies for this that please listen to the episodes on like asset location and how Dave and I do retirement income. There are ways that we try to avoid this being sizable for clients at the age of 73. If our client, like my clients that are in their 50s that are already retired, I'm planning for this. I don't want them to have some huge RMDs at 70 in their 70s and having to pay unnecessary tax.
All right. So there is a wrinkle when you hit 73. And this is the IRS just kind of playing with you. So what they say is, okay, you're 73. You have to make a withdrawal now. But they don't actually say now. They're saying when it's April 1st of the year after you hit 73, that is your deadline of when you have to take your first withdrawal. But you also have to take a withdrawal for the year after you turn 73 as well. So the thing that people get tripped up on is, okay, if I'm 73 and I don't have to take one until next year, then I'm going to delay it. I'm just going to defer this whole thing. And then they find themselves having to take 2 withdrawals in that year after, and they double up and they have more money in hitting tax brackets than they actually need to. So what actually happens is when you're turning 73, you should probably take your withdrawal in that year versus pushing it to the next calendar year and getting into a mess.
The thing I also want to talk about with RMDs, why we're paying so much attention to this, is let's say you only need $120,000 to live off of your portfolio, but they have $5 million in a traditional IRA. Guess what that RMD is at the age of 73?
Tell us.
It's almost $200,000. So this person is going to be forced to take $80,000 more from their IRA and pay taxes on it than they needed to. Point being, this is why you got to pay attention, because you don't want to be in this situation. You don't want to have to take more than you need to.
Yeah, if you're continually deferring this account balance, it's going to blow up in your face. Like you have to be proactively managing this.
Okay, so inherited IRAs. It's very simple if your spouse passes, okay? Because then you just inherit the IRA and you can make it your own and then take RMDs over your own life expectancy, okay? So that's easy. Those rules haven't really changed to my knowledge. What has been one of the biggest changes, if someone passes and it is not your spouse and you inherit an IRA retirement account after January 1, 2020, okay? You have to take the entire retirement account balance out in 10 years. So pretend you inherited $1 million retirement account and you got to take that puppy out in 10 years. That's either $1 million hit to your taxes or $100,000 to your taxes. One of those either or is probably jumping tax brackets, I'm going to assume. And do you know where people trip up on with inherited IRAs too? Roth accounts matter here. Inherited Roth accounts matter too.
I think that gets lost in the weeds. Everyone thinks, oh, it's a Roth account. If it's mine, there's no RMDs forever and ever until I die. And they don't actually think about, what if I inherit a Roth account? There is RMDs. So that's where there's that tweak in the rule change there.
Not as big of a deal because they don't have to pay taxes on it. But I guess we hadn't touched on this yet, but I'll say the penalties are steep for not taking RMDs. They're 25%. That's as high as they can get. Now they get waived a lot. You can get an exception. But if you do this over and over and over again and mess up, they're not going to probably likely give you the exception or abatement or whatever the term is. But 25% penalty if you get this wrong, no thank you.
All right, we've got another wrinkle we need to talk about.
Let's talk about the wrinkle.
So if you inherit the IRA and you then have 10 years to take it out, there is no requirement of when you have to take that out, except if the person you inherited it from was already taking RMDs. If that was the case, you have to continue taking those RMDs over those 10 years as well as liquidating the account. So you don't get that true flexibility anymore. You get, I have to take X amount per year, but I can take more out if I need to. But I can never go below what the RMD was. Let's give a scenario, because this is, yes, you have to follow rules, but this is a tax game at the end of the day with RMDs. So, short story for you. I had a client come into my office and they inherited an IRA from one of their parents. The account balance was $25,000. So the rule is they had already started taking RMDs, and so now they had to carry taking on RMDs. Well, if it's a small account balance, if you liquidated the whole account tomorrow versus if you took these RMDs piecemeal year after year, you're still in the same tax bracket. Your tax bill is going to be the same if you spread this out over years versus if you did this all tomorrow. So the tax bill is the same. So why would you not liquidate the account, get rid of the headache, pay the same tax bill as you would year after year after year?
But I think this really only makes sense, this strategy for our listeners, is if it's a smaller account balance. I will say my clients that have inherited IRAs from their parents, they were in very sensitive tax brackets. Let's put it that way. And so if I was to take all, because it's a higher balance, it's, 6 figures. If I was to take all of that in 1 year, it would be such a huge tax hit to them. So we are kind of taking it 1/10 every year to spread it out, to keep them from jumping tax brackets.
Yeah, this is hard to do if you're not doing a strategy each year. I will say, if you're not doing this with an advisor, you're likely going to get this wrong because there are so many rules to follow and get right. And again, if you don't get it right, then the penalty on the other end is severe. So if you're looking to get the most bang for your buck out of your RMDs, you want to do this with a tax-aware advisor, not one who's just pulling money out of accounts.
Oh, I actually have a funny story on this. So this was a retiree client. I'm weird. I don't require that I manage all my clients' assets. I advise on them, but I don't have to manage them. So it was a small balance, and it was so small. I'd remind him, okay, we got to take it. Well, finally, we moved everything over to Schwab under me. And I go calculate his RMD, and I'm like, we'll pretend his name's Bob. I'm like, Bob, why were you taking this amount the last few years? You only needed to be taking this amount. And he's like, oh, well, T-Row just told me what my RMD was, and I was doing that. And I was like, well, they calculated it wrong. I was just like, so you can't, I can't believe it. The brokerage house was calculating the RMD wrong. The other thing I want to note so that people aren't freaking out, if you inherited a retirement account from someone pre-2020, so 2019 and back, then it's still life expectancy table. It's only if someone passed 2020 forward that you now are under this new 10-year rule. Let's talk about retirees really quick. For many of my clients, I will say, we are taking some out of their IRAs now, depending, of course, on the size, right? If it's a sizable portion to their portfolio, we are taking some because I want to avoid having a huge RMD at 73.
Yep, we're playing the tax bracket game. Let's load up these tax brackets regardless of your age, regardless of your income need, because we're going to get this money out the account.
Yes. And when we say load up, I'm not loading up to 37. I try to target 22, 24. I like that tax bracket. I don't really like to go above that with my retirees. And then for inherited IRA, it really depends on how much it is. I think if it's a small balance, it's probably just easier to take the full thing if it's not going to bump your tax brackets. And if you're behind on your savings, your financial freedom goals, then just put it into a taxable brokerage account, something like that. If it's a sizable amount, understand the tax brackets and come up with a tax strategy for this account and know you have to take it out after 10 years of you inheriting it or the person passing. And if you have a low tax year, just because, I don't know, let's hope this doesn't happen to you, but you got laid off or, you took a sabbatical, consider taking more in those and fill up those low tax brackets.
All right. If you got one nugget out of this, we're going to ask you a favor. please throw us a like, a comment, follow, subscribe, whatever you feel like giving in this giving season, then we would appreciate it. Helps us expand our platform, share it with more people, and hopefully more people can get this information. So thank you. We appreciate you. We are going into our next segment. It's called What Would You Do? These are questions based on our content, hopefully just giving you a little bit more clarification on what we talked about. Question number 1. I am 67 and I have an IRA worth $2.1 million. My advisor is telling me to take money now, even though I don't need it. Can you explain why he would say this?
So you're looking at an 80 grand RMD without even factoring in continuing growth. And if the stock market on average, makes 10% and you're only taking out 4%, that thing's going to grow. So the reason your advisor is saying that is you must be in a lower tax bracket, and he's trying to take advantage of that so you don't have to jump tax brackets when you get to that 73 age of RMDs.
Yeah, 6 years of growth on 2 million. That RMD is going to be sizable.
I'm 71 and planning out my RMDs for when I turn 73. Okay, so they're 2 years out. People have been warning me about waiting until I turn 73 to start due to taking out 2 distributions in 1 year. What does this mean? Oh, Dave, you explain this.
This I feel like I have to explain a lot because it does get confusing. So you got a wrinkle when you're 73. When you turn 73, you have until April 1st of the next year to take your RMD. But in that next year, you've also got to take the RMD for that year as well. So when people are starting to talk about, okay, I'm turning 73, I would take your RMD in that year. So you're taking the account balance when you're 72, so December 31st of that year, using that account balance when you're 73 and taking the RMD, and then going into the year after that, you then only take one account withdrawal. That is purely a tax bracket game. You're still covering the rules, you're still doing exactly what you're supposed to, but you're not doubling up your contribution, your withdrawals in 1 year and one set of tax brackets. Question number 3. I am 75, have an IRA of my own, and one inherited from my dad who died in 2023. Both are requiring RMDs. How do I calculate these, and can I take the amount from one of the accounts instead of both?
You need some tax planning here, buddy. Yes, you have to take RMDs on both. You cannot just take it on one because it's based on the account value's previous balance. So you have to look up on each account what the 1231 balance of was in the previous year to then calculate the RMD on each account. So you have to take it on both. And the reason you got to take it on both, the inherited one, is because I'm assuming your dad is older than you. So he was definitely an RMD age too. So you have to take an RMD. And you got to take that sucker out in 10 years. So you need some tax planning.
Yes. This is one of those ones that trips people up because they're like, okay, so I calculated the RMD. I just took it from my IRA. I'm like, no, it doesn't work like that. Even though if this was a different situation and it wasn't your dad, maybe that rule would have worked. But it's a case of you got to take it from each account. Get some good tax advice here because this could easily go wrong.
Yes. All right.
All right, we're moving into highlights. This is where we talk about ourselves personally, professionally, whatever we want to share. Heather, you can go first because I seem to be dominating going first in previous episodes.
I had another speaking gig and it went really well. I shared
I didn't hear about this.
Yes, I did it yesterday. I'm kind of getting better at figuring out what to do when I speak. Don't wear heels. It's good to be grounded on the floor. Then I don't shake as much. And I did it on my 7 steps to build a solid financial life, which we should do it as a podcast episode one time. I kind of have this like checklist of things that I go through with everyone. And I got really good feedback and it just made me feel really good because again, I sit in my office a lot and I'm on Zoom, but yeah, I spoke in front of probably 50 or 60 people and I wasn't that nervous. And I think it was because I've spoken on this topic multiple times before with a much bigger audience. So it's kind of nice to be like, oh, all right, I got this one. And it was just nice to help a lot of people. But you know what the feedback that I got? There was a client in the audience. I love my client for this. But she came up to me and she's like, Heather, you need to own your fee. Every time people ask you about your fee, you don't want to talk about it. You say it really fast. She's like, you're worth it and then some more. Nicest compliment ever. But it's funny because my coach says the same thing. You're in my ear constantly, right? Like this is my one story that I have with money, right? Like my worth or whatever. Mm-hmm. And so I was just like, oh shoot, when a client says it to you, all right. I'm owning it from now on. I promised her. So I'm just going to say it from the rooftops now in promise of her. And I'm going to say it with confidence. My minimum is $20,000 a year. Okay, that's it.
Put it into the universe. Nicely done.
I know. I just got to own it. I was like, wow, I got called out. But also, I love that those are my clients that like give me that feedback. Like I take feedback really well. I want feedback. I want to always be better. And I really appreciate that she gave it. She's like, your speech was amazing, except this one part.
That is good feedback. When you, the feedback sandwich, when it's good, here's part to improve on. Here's another good thing.
Okay. What's yours?
We hit a milestone in our house of, we're in the holiday season of Halloween, Thanksgiving, Christmas, all of those leading up to one another. We started our conversations in Halloween of when are you going to be trick-or-treating? Said this to our 15-year-old. He didn't have a choice. He had a football playoff game that night, so he wasn't trick-or-treating.
Whoa.
And then it got moved. Halloween? So he could have played it, but they moved the day and then it opened up his night and he's like, yeah, now I have football practice for the game. Said no. So he's done. Then we looked at our 13-year-old. We're like, when are you trick-or-treating? He's like, I don't know if I want to. And I was like, this is a new world of either we can't trick-or-treat because we have other stuff going on or not sure if we want to. So he went to his friend's house. There was a group of them. They trick-or-treated for an hour in a 4-hour time block in our town. And then they chopped wood for 2 hours.
Chopped wood?
Yeah.
That's what kids do. I've never heard that. That's like a beautiful thing. It sounds like we went back like 100 years in history, chop wood. I haven't heard anyone say I just went out and chopped some wood. This is what your 13-year-old boy is doing. You should be proud, Dave. Honestly, I like genuinely mean that. That's incredible.
He's never chopped wood in his life. He's never held an axe before. So this was all news to me when he came home and he collapsed. He's like, I'm so tired. I'm like, why? Like, I just chopped wood. I'm like, okay, is this a new middle school acronym for something? Because I don't know what you're talking about. He's like, no, they had a down tree. We were chopping wood. Like, okay, good for you.
So cool. That is so cool. Good for you. Like, that's awesome. On a little tangent, my kids have forgot about their Halloween candy, so I think I'm going to throw it out.
We had so much left over. Like we were on the corner of a really busy street, but no one turned down our street to trick or treat down ours. So we had the basket outside because we were driving kids around and we're like, just grab candy. We're not going to open the door because our dog will attack you too. And no one came down the street. So we have like 2 big bags of candy left over, which as the guy who works at home, I don't like that. I do, but my waist doesn't. Anyway, enough about me and my waist size. All right, thank you for listening to this episode of Playbook of the Wealthy. If you want to listen to some more, we are available wherever you listen to podcasts. If you want to catch the video version, we are on YouTube, Spotify, Instagram, LinkedIn, anywhere you can look at videos. If you want to send us an email, you can on our brand new website. You can go to playbookotw.com. You can email us from there. It is hello@playbookotw.com. And we will see you next time.
Toodles.
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.